A lot of macroeconomists seem to think that we have a soft landing. I find that hard to understand why they see that. I think there are more similarities than there are differences to what we saw before the financial crisis. The US consumer is absolutely struggling. Retail sales is not strong. We also see now credit card delinquencies are coming up. Personal interest payments are still sky high levels. And we see also the housing market has not done tremendously well there. And if you look at some of the normal recession indicators that we see, well, they are all flashing.
Henrik, do you believe we could see an economic crash as bad as or worse than 2008?
Yes, I see it worse than 2008. And the reason is that the bubble is bigger this time around because of this artificial stimulus, the QE. We need to understand that there is a limitation to monetary policy. And I think that limitation will show very soon because it's simply been blowing up the largest bubble we have ever seen. And that is going to come to haunt us for some years now. And the bigger the bubble, the bigger the bang.
Economist Henrik Zeberg says that he finds any economist calling for a soft landing insane. No, actually, he just says it's hard for him to understand. But friend Zeberg says that all of the warning signs are here, flashing, alarm bells are going off, and what he believes will show up in December will be a massive recession. Now listen to what he says to determine for yourself if we've manipulated this U.S. economy, the Fed interest rate, the jobs reports. If we've actually gone too far this time, Zeberg actually believes that what he is seeing will result in a massive reset to asset prices. And folks, that includes housing. He says that we're going to see these asset prices come down to earth again. The real question is, what kind of an impact will that leave on our jobs market? And will we see a recession or depression? I hope you enjoy the show. Henrik, thanks so much for joining me today.
Thank you very much for having me on.
You're a macro economist, and many economists believe that the U.S. economy is strong. They're telling people through mainstream media that inflation is down, jobs are being created, and that the Fed has actually achieved a soft landing. However, many don't realize that some of these same economists are pushing narratives for special interest groups that are not necessarily in the best interest of the American people. And despite the news stating that our U.S. economy is strong, many Americans are less optimistic. And one of the reasons, Henrik, is because they're feeling the pain of inflation and they have lack of savings in their accounts for emergency. They're living paycheck to paycheck, unaffordable housing, and now job losses are starting to show up nationwide. So, Henrik, as we get started here, can you tell the American people why they should listen to what you have to say as an economist, especially when you share your less optimistic views of the U.S. and global economies right now?
So I think, as you said, a lot of macroeconomists seem to think that we have a soft landing. And I find that hard to understand why they see that. I think we have a lot of similarities to what we saw before the financial crisis. In fact, there are more similarities than there are differences to what we saw before then. And if you look to the consumer, as you also pointed out really rightly, that we see the U.S. consumer is absolutely struggling. And we see that the only thing that is standing right now is, yes, that's the labor market. But if you look at the consumer, well, retail sales is not strong. We also see now credit card delinquencies are coming up. And it seems like the savings that was kind of, saved up after the stimulus came out has now kind of vanished. So I think we're a completely different place. And if you look at some of the normal recession indicators that we see, well, they're all flashing. And that's why I find it difficult to see why we this time around should see a soft landing, especially when you look at the interest payments. Personal interest payments are still, at rocket or sky high levels, which have, normally been what leads to a recession. So I find it hard to see the soft landing. I do not know where they see that soft landing. Actually, I think if you ask the consumer, as you said, also, they do not feel any soft landing whatsoever.
So when you're looking at some of these indicators, though, Henrik, I mean, what makes you different than these other economists that are saying, that the Fed has achieved his goal?
I don't know. I look for what the indicators are. I mean, first, one of the first thing is that the yield spread, when the 10-year minus the 2-year, yield spread, we have we have had the longest inversion that we have seen for, ever. Actually, I think it's the longest ever, and that, tell us something. We have seen that the leading indicators that the conference board is coming out with actually told us that in the model that I use, that we have a recession signal. If you look at the different, I would say I think it's called the Piper-Sandler recession signal for the labor market. It's also starting to flash in the SAM, the recession signal for the same. It's also flashing. And we see also the housing market has not done tremendously well. There are for certain indices, if you look to the housing market, which normally leads the economy, actually. So if you look at all of these things and you start to see now that the consumers also start struggling, and you see, as I said, the credit card delinquency is also coming up in a way that we saw before in the financial crisis, I find it hard to see why we should see a soft landing this time around. And yes, there will be a time from when the Fed acts and inflation starts to come down that until we see the recession, but that's the same the last time. And we are close to now to see actually that the yield spread is uninverting again. And actually, the real recession signal comes when the yield spread uninverts, and that we are very close to. So I think what we saw last week also in the Japanese market is some of that unraveling that we will see in the economy, and that will come to the U.S. as well.
Yeah, there aren't a whole lot of countries that are saying that they're doing well, that their economies are thriving. In fact, I've got a website I want to take a look at with you. But I think what I hear you saying is you're looking at the same indicators that the consumers are feeling, and that you're really not serving any special interest groups.
Oh, absolutely not. And I don't hope for any recession. Absolutely not. I mean, I hope for, progress and, prosperity for everybody. There's no reason for that. So I'm not serving any interest here. Yeah. I'm just saying, if you look at things, it doesn't look good. It doesn't look like we are, having any sort of soft landing. A soft landing would indicate that interest rates were down to normal again, and the consumers were starting to spend, and that we do not see the rise in the unemployment rate that we see. And we actually see the exact same. And we also start now to see that the 2-year yields are declining rather fast. And you normally see that into a recession. So I don't think we're far from a recession here. I think I think December this year, I think that will be the time for the recession to begin.
Well, a lot of it, and we'll discuss as well, I think, is being propped up. We're in an election cycle here, and I think that may have a lot to do with it. But, ultimately here, guys, I want to leave you with some actionable steps after Henrik kind of unpacks some of the points that I want to go over with him. We're going to leave you with some actionable steps that you could take to protect yourself. I know, we're not trying to spread doom and gloom. We're trying to make you aware of some of the possibilities that could happen here. That's not being covered under mainstream media. And then usually, once they start talking about it, it becomes a self-fulfilled prophecy. But should an imminent collapse happen in the U.S. economy, we want to kind of give you some steps to take now to prepare. And as you guys may know, I'm a real estate broker, and but I cover really the overall state of the U.S. economy because it's critical for housing. And as someone who's been serving the housing market for more than 35 years, I've never seen affordability worse than right now. And I believe if it weren't for the government handouts, kicking this can down the road, we'd have already seen massive foreclosures and evictions, even more than we witnessed in the great financial crisis of 2008. But as we get started, Henrik, do you believe we could see an economic crash as bad as or worse than 2008?
I see it worse than 2008. And the reason is that the bubble is bigger this time around. So if you look at the asset prices that you have on the stock market, you can simply just look at the Warren Buffett indicator, the market capitalization to GDP, and you see that's at 200%. Back when we saw it was 130% during the dot-com days, we were all laughing and say, oh, why didn't we see that was really a bubble? We saw it was 109% before the financial crisis. And everybody was saying, oh, we now see that was a bubble. And then 1929, by the way, it was also 109. I think it was around the level. And everybody was saying that was a bubble. Now, this time around, we have that at 200%. And we have a crypto market. And the crypto market is I still think we're going to see a blow-off top in risk assets in U.S. equities. I would say I think a lot of foreign markets have already topped now, but I think the crypto market and the U.S. assets will see a very, very strong rally into the coming months. And if we end up at the levels you're seeing there, we'll have a crypto market of around 6-7 trillion. If that also blows, and together with the equity bubble, well, then you're going to have a lot of deflationary pressure, I would call it, and that's why, yes, it's going to be bad. It's going to be really bad, and you're going to have a financial crisis as well. I think you're starting to see that unraveling now in Japan. If I look to the chart of Bank of America, it does not look good. I think there is going to be a level lower than in 2009, and I think a lot of financial institutions will suffer. So I think, and again, I do not want this, and I'm not, I'm not thriving in any way to say this, but I just look at the numbers, I look at the indicators, and there are so many similarities. And the bigger the bubble, the bigger the bang.
So, from what I hear you saying, I mean, do you think that we could actually see something here in the U.S. that was or is worse than what we saw in 1929, the Great Depression?
Not worse than 1929, because I don't think we're not at that. I think it'll be worse than what we saw in 2008, and the reason is that we have a bigger bubble simply, and it's more widespread. It's in everything this time. Last time it was in real estate, and we had the .com where it was in. Yeah, also manageable, but you really didn't see a strong housing crisis back in the .com days anyway. But but not 1929. I think that was another kind of ball game. It was also the ways to handle the crisis were completely different. So I think we'll not see that. But what I do think we will see is that this time around it will not be like 2008. It'll be a deflationary bust like in 2008, and we're going to see the Fed react, and we're going to see central banks around the world react like what they did back then, thinking that will save the day again. But I think there's one thing that has changed this time around, and that is the consumer's behavior. Because if you think of it, as you also started out by saying, that inflation has been tough on the consumer this time and spiked up so fast, and the same did with the interest payments. Well, if you're the consumer and you're looking at that and you're starting to see also that you could potentially lose your job or you lost your job, well, if you save another $1,000, or will you then go and spend it immediately, or will you say, well, let's save it, because then we'll we may need it in the future to pay our bills. See, that's the real economy. That's the real consumer thinking like that. So it's not the financial markets where they just say, oh, just give us some QE. Let's give us some heroin there, and then we'll just get high again. No, that's not how it works for the real economy, for the consumer. So I think that is what we're going to see, that the real economy will actually be sluggish, even though they will try to QE it again and all the way up again. So I think there will be a bounce when we see the deflationary bust that I think is going to develop, let's say, start of top in October-ish, around that time, and then a recession beginning in December, really to be felt in early 25. Well, then I think they will at some point get back in again. But we have to remember also the Fed is scared; they're spooked by their own actions, so they do not want to get in too early either. So I think we can see markets fall more than before they will feel that they will have to get in. So again, when they then do it, I think they can unleash something quite different, because if the money does not start to circulate in the real economy and the consumption does not get boosted by it, well, then it'll find speculative ways to go in the financial system. And that's why I think you can see a commodities boom coming out of that. But that will drive also a potential stagflation and a potential longer crisis then. And that will be very bad for the consumer, because if there's something that we do not like as consumers, that is prices going up while we lose our jobs. That's absolutely not good. So I think this one will be bigger. It will be deflationary wise, what we have seen before, and then we'll see the Fed will react, but they will actually then start, ignite something that can potentially be worse, and that will require more of a structural reaction, which will come down the road.
You talked about consumer behavior, and the $1,000, if they have $1,000, are they going to go out and spend it, or are they going to save it for a later time? We see home buyers, so many of them have less than $5,000 in the bank. I mean, if you look at, they're living paycheck to paycheck, they have credit card debt. In fact, I talked to a lot of mortgage lenders, and they say that the hardest part is their debt to income ratio. That right now they are so in debt with revolving credit cards. They went out and they bought automobiles at the highest price we've ever seen during the pandemic, where they were going for $8, $10, $20,000 over the sticker price, and they're financing these cars for 7 years. I mean, they have over $1,000 car payments. Some of them thousands of dollars a month for one car, and so I agree with you on that. Plus, we're starting to see where credit is tightening, and what you're describing is, it really doesn't matter if the Fed does more easing, quantitative easing, which we'll kind of talk about and explain that. That may not even be enough. It may not, just dropping interest rates on loans. A lot of these consumers have fallen behind. The banks they're not going to give them more credit. So let's talk about central banks for a minute, because a lot of people think, this everything bubble. And if you look at the global financial crisis, just the housing market alone, and look at how much bigger the asset bubble is in housing, not counting every other, the stock market, the S&P, which we'll discuss. But a cut of 50% in asset values, or even in the stock market, would seem to be more practical or possible, and would be devastating. But when you look at how big this bubble is, I don't think it's impossible to say that we could see those kind of numbers. But what are some of the mistakes that, as an economist, that you believe that central bankers and that the U.S. government, Treasury Department, have made in fueling this potential disaster?
Well, I think in general, I think in 2008, when they embarked on this QE journey, and then now it seems like to become a whole new theory. It's like MMT, and we give apparently also the Nobel Prize for that. Well, it's printing money. It's about putting more money into the system, and then you stimulate and you push interest rates down, and then the valuation levels move up. It is as simple as that. They can call it whatever they like, but that's what it's all about. And when you do that, obviously you can create a boom for some time. And then if, things can get going, and they hope then that you'll have the trickle down effect on that. And then you'll see consumption start to move up. But guess what? The long-term growth rates have not been moving up over that time. So what they have done is really that they have exhausted, or they're trying to shake out the last, drop of growth in this economy by lowering interest rates and printing money and pushing valuations up like this. So that's a major mistake, and that can go on for a long time. It's been now 16 years since we started being embarked on that journey, and it can go on for a long time. And we will everybody will say, oh, what a fantastic miracle they just pulled out there. But it's not. And we will see the day where, these valuation will come down to earth again. And just the fact that you have something as speculative as crypto, and I'm very bullish crypto right now because I'm riding the bubble of that, but as speculative asset as that, is simply a consequence of these cheap money. So if money is cheap, you will see that, people try to find ways to why not, do something that, yields 0% if it costs you 0% to loan them or to have the money, hold the money. So that's why I think, we have created a bubble that is so much bigger because of this artificial stimulus, the QE, and also what we did after, and that goes for every administration and central banks of the world. After Corona, during Corona, what did they do? Well, they saw it as a demand crisis, but it was not a demand crisis. It was a supply crisis. So what they did was that they poured a lot of gasoline on that fire, and they just said, "Hey guys, you got money from fiscal stimulus and monetary stimulus and lowering your interest rate to ridiculous low levels." And what did we see? Demand just shut up, and everybody just started to go spending, and that was a good thing. And that's why we saw everything just surge. What happens then? Well, then you see all companies of the world say, "Well, we do quite a good job here. We are up 130%, on top of our budget from last year. So we need to build capacity. So let's build more capacity." And that is not just, in the US, that's across the world. Everybody, this trickle down of this extreme amount of money or stimulus. So that has caused, an even bigger misbalance because then now all of a sudden now you have, companies building up capacity while the demand is waning off or, coming down again, because that was artificial stimulus. So the companies now been waiting for a little while and saying, well, and you can see that if you look at the job openings across, in the US, for instance, they have just been, never been this high before. It's been extremely high. I think we're up to with 2.2 jobs, open jobs per unemployed in the U.S. It's quite extraordinary. That's why you have so low unemployment rate as we have had. And all of a sudden, then when the companies don't see that the demand comes in, well, then they'll have to cut the excess capacity that they've been building up in terms of people or warehouses or whatever it is that have been building up. And that is also going to be an extra, effect on that deflationary push on the bus that I see, because people are now starting to feel the aftermath of what they did. They created extreme inflation by pushing demand into or stimulating demand into a supply crisis. So people go home because they can't work because of Corona, and then you stimulate demand. Doesn't really make sense. And what will you get out of that? You get inflation. And that's what we saw. We saw extreme inflation. And what happens after inflation? You get interest rate spikes or a spike in market yields. And that is what we've seen. And when that happens, well, these are the two whammies to the consumer. Inflation up, and you also pay more on your debt. What are they going to do? They're going to pull back on spending, and that's why we see it always comes back down to earth again. So they have done, the central banking needs simply to get I think a new set of tools here and work, to have other ways of, trying to support the economy and not trying to think that they can actually micromanage. So and also when I hear something like, we want to, lower carbon dioxide or the emission of that, and then we start to talk about the central banks and that. Come on, it's ridiculous, simply ridiculous. We need to understand that there is a limitation to monetary policy, and I think that limitation will show very soon because it's simply been blowing up the largest bubble we have ever seen, and that is going to come to haunt us for some years now.
I hope you're enjoying the interview so far. I would like to take a moment and let you know that this podcast is being sponsored by none other than SachsRealty.com. If you're in the market to buy, sell, or rent real estate and you're in Maryland, we hope that we're your number one and only choice. But if you're anywhere else in the country, we hope that you take advantage of our amazing broker network so far in multiple states and cities throughout the country. Just visit SachsRealty.com, click on your state in the map of the United States, and drill down to your city of interest to find one of our trusted resources. Now, because this is such a new program for us, if you don't find an agent in your city, send me an email and I will personally connect you with someone that I trust. Now back to the show. I think you explained that very well. If you look at, we put everybody in at home. We locked everyone down. We gave stimulus money. We paid employees basically to not work. We gave them on top of state unemployment, federal unemployment. And a lot of people thought, hey, this was going to be the way of life from this point on, not thinking that they'd be called back to the office. So they were spending money on their homes. They were updating. They were going out and buying new homes. They were saying, I don't want to live here. I want to live there because I can work remotely indefinitely. And then just like you said, the employers, they weren't ready for the demand. So they started paying people a lot of money, giving them recruiting bonuses just to get them employed. Now that the demand is backed off, they're looking at these employees saying, I'm going to have to let you go. So I think the lag effect is going to eventually catch up. Common sense tells us that. I don't know why. Why do you think that a lot of the economists, and especially the American people, believe a crash will never occur? I see it in the comments section. We talk to them about, hey, these things, this is not great where we are right now. The debt, the consumer debt, inflated prices, it's unsustainable. They believe that a crash will never come because the Fed will just bail them out. They'll do more quantitative easing. The U.S. Treasury will just, authorize the money machine and continue to manipulate the interest rates and continue to print more dollars. What are your thoughts on this? You said that it could continue for longer. What are the implications of, and maybe you could explain quantitative easing for people that don't understand it. But how long could they keep this going? What could be their next play that would even keep extending this or preventing a recession?
Well, quantitative easing, and I heard there was an advisor to the U.S. administration who was not able to actually explain this.
Why does the government even borrow?
Well, some of the language and concepts are just confusing. I mean, the government definitely prints money, and then it lends that money by selling bonds. Is that what they do? Yeah, I guess I can't really talk. I don't get it. I don't know what they're talking about.
There was an advisor to the U.S. administration who was not able to actually explain this, but it's quite easy. I mean, there's a central bank, it's a Federal Reserve. They can print money, as they also said, and they can do that digitally. And what they do, they push at a button, and then there be an extra zero on that, the balance sheet there, and then they can go out and they can tell the Treasury and say, hey, we want to buy your bonds, and we buy your bonds. And if they do that, there is a large demand for that through the buy or the demand from the Federal Reserve. Well, then you'll see interest rates being pushed down. And that is what they have done. And that is what, they will do. And what will be the limitations? I mean, again, I think it's Mises who said also this about that, an artificial boom created through credit expansion would either come down voluntarily or involuntarily. And that will happen by, either say, okay, we cut it off, we stop this, and then things will crash, or it comes down through a complete destruction of the financial system. And I fear that we are getting, maybe not to that point, but we're getting to a point where a stagflationary development could, or stagflationary phase could be happening, and that would be very, very harming and devastating for the consumers. So, how far can they take it? You could say if we were so simple that we were robots, like that, so every consumer, every time they got $1,000 in their hand, they would spend it immediately. Then we could put it into an AI kind of, machine, and they will understand that, we need to put this much money in, and then we can create demand, and then, it will be easy. That's not how the human mind works. The way we work is that when we've been seeing a recession, or we've seen something, we've seen inflation, we've seen, higher interest rates, we'll think, oh, we need to take care. We want to take care of our families. Obviously, everybody wants to. And that's why we want to say, well, maybe we should save this money. And that's why I think, and that's also what you see, that the marginal return on QE is becoming less and less, and it's declining. And that's what we think. I think will happen here again, and I think it's going to be, even worse this time, because you'll see that the consumer simply will say, well, I'm not going to spend this money. I'm going to sit on it because we need to, build a buffer now again to make sure we don't, we can pay our bills in our house. We have to remember the last thing people want to do is to sell their house. Obviously, they will rather cut on all other spending. So luxury goods and those things are what we see first. And now we start to see it also coming into more, consumer goods things, normal stuff that people can pick up, a Starbucks coffee or something like that. And you start to see also that there is at least some earnings that do not look, as good as they should in a booming economy. So I think we see that the limitations to QE that will come when the consumer actually starts to act like out of common sense and say, I need to build a buffer and I need to hold back on this money, not to spend it. And I think that's where what I call them the liquiditists actually are mistaken, because they think, oh, but you just print the money and then it immediately comes right into the economy, into the system, into the consumer's hands. Well, it does not. What it does is that it goes into the financial system, and that's what I think we can see. But that gives us a lot of time, and we also saw that during the financial crisis. We saw that I think since 2007, or from 2007 up to 2009, I think the global liquidity of the largest central banks actually came up like 40%, and we still saw one of the largest recessions we have had. So this about that we can just print money and then think that things will be fine is simply misunderstood. And I think that is one of the largest. Let's say that's one of the the factors that can be really dangerous for the consumers and for the investors, because if they think that the Fed will be able, I see comments like the Fed will not allow the markets to crash. I mean, think about it. That's how far people have started to believe in the Fed, and that's quite scary as I see it.
one of something that's coming to mind as you were talking is, and there was a group of business friends of mine that we got together and we were talking about sort of the state of affairs, where we are right now and what's everyone thinking, how's their business doing and so forth. And one of the things that came up, Henrik, is that Americans from birth are really conditioned to spend money. I mean, if you think about, on a global scale, since the 1970s, we don't really make anything. I mean, I can remember as a kid growing up, things were stamped, made in the USA. I mean, it was on a lot. We shipped we offshored our manufacturing, and greed, I'm sure, was a big part of that. How do companies, they take their money to cheaper labor supply across the globe. And then, of course, the government's all for it because of, tariffs and, import tax and stuff like that. But Americans are purely driven to spend money. I was looking at, and I don't remember what the website was, but it was basically talking about the richest economies on the planet. And we were bumped down to like number 9 as far as the countries that were the wealthiest. And what really bumped us down was the amount of labor, the amount of time we have to spend working to buy life's essentials. And that really made us not the richest country. It bumped us down to number 9 on this chart. And, and I think about when you were talking, I'm thinking about, all we're doing is spending money. We work, we spend money, we work, we spend money. Whether you go to Instagram or TikTok or whatever it is, somebody is shoving this new outfit in your face and we feel we need to buy it. And now we're seeing millennials going crazy with this doom spending because they're so depressed. They feel they can't afford a house. Their friends are, losing their house or, whatever the case may be. So they're just blowing all their money. And what you said is that we need to start saving money. And I think if people are listening to this show, one of the things that regardless of whether we're right or wrong or whether the recession's put off another 25 years, Americans need to start saving money and spending less. Now, on the flip side, we're part of a global economy. And the globe is dependent upon us continuing to buy that coffee at Starbucks because they're importing the bean from somewhere. And that's creating a job and a farm and a whatever across the globe, right? But I want to take a look at something right now and then kind of talk about it. Pew Research published an article on June 7th, and we'll just kind of quickly look at this. But it's titled "The Economic Ratings Across 34 Countries Are More Negative Than Positive." And of this, France, Greece, Italy, the UK, Japan, South Korea, I mean, the list goes on. I mean, does this tell you anything about the U.S. economy so far? Or are the declines of these other countries a plus for the U.S. economy? I mean, where do you think all of this on a global market, how many of them are looking at us, dependent upon us, or, that they're trying to break away of us? I mean, when you look at these bad economies or where when they're polled, the people are polled, they're saying, what, things are pretty bad here versus things are pretty good here. Where's our role in the United States on all of this?
First of all, I think the U.S. has a major impact on the world, and not through necessarily only through consumption. Actually, if you look at it in terms of technology, and then you look at the universities in the U.S., there's no doubt that the U.S. is having the largest, the best universities in the world, and I think that is fantastic, and that is driving a lot of innovation, and that is good for the world. And I think that innovation needs to come out to countries, and that is, it's normal in the long-term time frame. You will see that certain technologies comes up, and we then exploit them for some time, and you'll then see that the long-term growth rate then slowly declines. And then as the central bankers try to keep it up, they will keep the growth up. They will start to stimulate, as what we see right now. But what we really need we really need that technology breakthrough. And I think we are on the cusp of that also. So I think what we're seeing with AI, machine learning, robotics, and all these things here is going to give us the next leap, into a new technology, future, the fourth industrial revolution, I would like to call it. And I think that is going to do a lot of good to us. But that is needed. And what I think you see there in those numbers is actually that we have now been trying to squeeze out the last, drop of growth in that old framework on the old technologies that we've been exploiting. And there are still countries in the world, and we live next to Germany here, and they still use the fax machine. I mean, there is like 40-50% of the German companies that they use the fax machine. I mean, we could start to look at some of the technology improvements that you could do there. Simple, very simple, improvements there. But I think what we see now, what comes with AI, machine learning, robotics, and so on, is going to completely change the world. So my kids, they will be working in a completely different world, and your grandkids also. I mean, they will be doing something completely different from what we do today, and I think that is healthy. Because of course, the U.S. economy may have become strong in building certain things, maybe been building, automobiles and whatever it was back in the days. But I think there will be a movement of that, and it'll be good for the world to see that these technologies come through. But it requires sometimes that time, first of all, adaptation from consumers, and also adaptation, and that, companies start to do that. And sometimes a good crisis is what is needed for that. And I think maybe this crisis this time around will actually, require for a lot of companies to say, well, not just in the US, but also across the world, to say, well, we need to be less dependent on people, or we need to, to pull in some AI or whatever it is. And I think we have only seen, 1% of what the possibilities are there. Will that be good in the short-term time frame? No, it will not, because a lot of people will then feel that they are standing in a completely new situation. But in the bigger picture for the US, for the world, I think that is what is required, even though there will be some, casualties in brackets, of that change in technologies. So I think what we're seeing with those numbers is really that that the growth levels are simply too low in the world, all of the world, especially in industrialized countries and in the Western world. And we'll then hence start to see that deterioration of the growth rate. But that needs a new boost. And that's where also, as I started out by saying, the US has a major role, because you have the best universities in the world, and you need to educate some, strong young people, and, let them come tell us how we run the world in a better place and in a better way.
What you're describing, I believe, then will be more connected globally, where people are saying, everyone looks at the U.S. as this superpower and, dominating, in defense and with our military, and certainly our military spending. We spend more than probably anyone else in the world for our defense. But when we look at it and we say, what you're describing, and many people are saying this, that AI is going to be very disruptive. And I think on the short term, one of the things that I think, and I do believe that you're right, that we need some kind of disruption, because a lot of people feel they act very complacent at their jobs. They feel like, their employer owes them a living. The world owes them a living, for crying out loud. I mean, they don't try anymore, right? We're beyond we're in the world of, and I'm going to get some hate on this one, and that's okay, because I'm an employer and I see it. But for those that I say, if the shoe fits, wear it. But what we see a lot of times, I mean, look, we're expanding here in our brokerage, doing lots of things like what we're doing right now, getting the word out to people. It's creating more jobs on the digital side of things. So we're looking for, people to help us grow our business together, win as a team. But it's very frustrating. People don't show up for interviews. They set appointment schedules. They don't come. They are full of excuses. They don't prepare. They don't write cover letters. Their resume isn't updated. They say they're employed when they've been unemployed for almost a year. We have a lot to learn here, and I think that you're right, and sort of off topic, but disruption is good. But what employers are really realizing here is they're saying, you know what, I'm not going to be strapped by this employee that I'm paying a ton of money to, that isn't getting it, and is certainly not caring whether we succeed or fail in the day-to-day struggles, especially as any kind of recession hits or business slows down, they're going to be gone. They're going to be writing these people off. They're going to be looking for ways to innovate their businesses with AI or automation to try and get rid of people. And I think that what you're saying, what I'm getting out of this is really in the direction of, what we're going to see where, countries like India that are depending on the U.S., we may be depending on India. We may be outsourcing a lot of our own work or trying to get hired by other countries because AI is going to take a lot of jobs. So that may connect us. I mean, how does that sound? I mean, is that, you think that's possible?
No, absolutely. But I think there will be a greater, interdependence on each other. Even though with some of the, some trends that goes in the other direction these days. But I think there will be that in the future also. But it will come down to also about technology and on the adaptation of that technology, because you can say that we have for many years lived in a world where we could, offshore labor, but actually in the future it'll be easier or it'll be cheaper to actually have it in-house and to do it, AI wise, and to do, instead of having to have, foreign or people sitting in India or elsewhere to do that particular job. So I think we're going to see a shift here again, and maybe that's fine. I mean, that's probably also will be good to, sometimes to be shaken up. But I think in the shorter time frame, it may, disrupt a lot of companies out there, and also companies that we wouldn't really think of. I mean, I also work with the legal companies for many years, and you'll see that it'll be only the top of the the legal advice that you need to pay for, because the rest you can actually just go to AI. And it will become easier to actually get your legal support there. Obviously, you'll go to your lawyer afterwards and say, hey, what do you think of this? And then they can put in an extra dot or two, and then they you'll have it. But I think everything will need to be refined a bit more within this world here, and that's why the adaptation for businesses is extremely important, that they take it in. How does it fit into our business? How can we utilize it? And again, then understand that there is of course a transformation, but but there will be an end state where the processes and the way the businesses are working today will simply be completely changed. So yeah, I think a lot of businesses will see that, and there is a disruption, and that's also why you have businesses now that are working globally. I work at the Swiss block. One of the people I work mostly with, and one of my good colleagues, sits in Guatemala, and we work together. We wouldn't have worked together 20 years ago, I think, because then we'll have to sit together. So these small things are changing our daily lives, and it's actually about becoming the best at what you do, and you'll need to adapt any technology to that. And AI is just the next thing here, but that's going to change a lot as I see it.
Well, in opening up this conversation, I spoke about wanting to leave people with some actionable steps that they can take. I mean, I think that learning your trade and how can you serve a broader audience and even abroad. If you're here in the U.S., how can you market your services or what you do to people in other countries? I think that's I think that is some good advice on protecting yourself with just having a 9-to-5 job where, the boss may come in one day and say, I'm sorry, but I don't need you anymore. So let's kind of talk about the interim, some of the steps that may sort of be the chain of events that could throw the U.S. into a deep depression. I hear you talk about the stock market a lot. You say that the S&P 500 more specifically is, overvalued. That do you think it is topped out? I mean, I've heard you say where it could go before it goes down, it could even go higher. But what's your position on that today?
So I think I have a target on the S&P for at 6,100 to 6,300. That is where we're going. As I see it, I see a lot of similarities to what we saw in August of 2007. We actually had kind of the last week was kind of the same what we saw in the week of August 16th, 2007. We saw the same kind of panic coming out, not really supported by any real factors, real economic factors in the U.S., but more of something that was starting to brew, which was the subprime market back then. This time around, I think it's going to be something quite different. I think maybe Japan could be the epicenter of something, and I think that will eventually drive the bear market, drive the recession. So the slowdown of the economy is happening right now as we see it, and that's because of the higher interest rates, it's because of the consumption we talked about, all that, which will drive the economy into a recession as I see it by end of this year. But how big the black swan events that we could potentially see, and I think we will see that. We have to understand that black swans do not normally start a recession. It's the recessionary environment that creates the black swans. That's what we saw with Bear Stearns in 2008 in March. That's what we saw with Lehman Brothers in September 2008. It's way into the recession. So the moment that when the recession begins, and that's when we really start to see the deterioration. And I think until then, until the next coming months here, until October, I think we will have a very strong bull market here in the US, well, as I have to say. And I think we're going to see that number on the 6,100, 200 to 200 on the S&P. And then I think we're going to see a top there. Will it then crash immediately? No, I don't think so. And when we get to November, December, I think we could see that, they have taken a dip, maybe starting to bounce a bit. But getting into next year, then I think we're going to see a large decline. And I think that the things will really start to unravel there. And it'll be very clear for everybody that we have a severe recession. The indicators are that this is going to be bigger than what we saw in 2008, and that's also why I think the bear market will be bigger. And I think that there will be a complete destruction of a lot of cryptos, which will mean a lot of value coming out there, and a lot of small caps also. And you have all these new startups that comes after, especially after Corona, the stimulus, that simply do not have a viable or sound platform or business plan that that works, and that's why I think some of these companies may also go bust. And we also know a lot of S&P companies actually do rely on low interest rates, and right now are struggling because of the what we see in the economy. So I think we will see more highs before we get to the end of this business cycle, and then I think the economy will start to deteriorate. As I said, I think it'll be around October, and I think potentially that the recession that I see will start somewhere or sometime in December or maybe early next year.
Are there, because a lot of people listening may be invested in the S&P, and and whether they're doing well with it or not, they don't want to lose their money. I know leading up to the GFC. A lot of people I know lost a lot. I lost a lot of money. I mean, because you're thinking that, well, something's going to save it, right? And eventually it came back. But we did see companies like General Motors, for instance, bankrupt, went to zero. I was invested in that stock and lost every penny. I kept buying it as it was going down. I'm thinking there is no way they're going to let General Motors, GM, go out of business. Well, sure enough, I was wrong. But what kind of indicators, and I know we're not giving financial advice, we're not financial advisors, but if you had to, just from an economist standpoint, everybody, you have to make your own decisions. We're not telling you to pull all your money out that the stock market's crashing, but what indicators could somebody follow that you follow that would tell them, hey, we're at the new top, or, there will be some kind of a bust, or, talking about the stock market now, because that kind of seems to be the catalyst. If we look at the GFC, I mean, that was certainly the catalyst. People were taking their money out of the stock market. They were dumping it in the housing market, saying that would never fail. So they lost money on the stocks. They lost money on the housing market, and because house prices did go down. So what do you look for? I mean, do you look for manufacturing stocks, transportation stocks? What are sort of the things that lead the way?
So one of the indicators that I look at is actually market yields. So when you start to see a plunge in that is a good time for a good indication that things are starting to unravel and starting to move fast. So we actually start to see some of that when we had the panic of last week. And that is one indicator that is, people say, well, that's a good thing. And it's liquidity the financial conditions are then that are not as, tough any longer or severe. I think that when we start to see that is the tell sign that things are starting to decline very fast. So I would look for that. And again, also, bear in mind that that could be getting close to the top of the stock market, because when that happens, then you normally start to see the decline in the stock market. So we have. I think it'll be about being careful into this. What I call the blow off top into the final phase of this, that you do not get too carried away, and then do not buy too much into this, so that the Fed will just save the day and they can just print us out of it. And that people actually look into what they see in the economy. And also when the initial claim starts to move up, that's that's the canary in the coal mine as well. When they start to come up and they pass 350,000, that's normally a good indicator for when we see the recession beginning. So, and currently they are historically low. So everything is okay now that we got the labor market is rather strong, but the market yields, the 2-year yields, and the initial claims are the real economy that you should look at, and not so much. And then if you can, there are a lot of technical ways of looking at the market, but I think you will also see that there will be what is called a deterioration in the momentum of the market. So you don't see the same kind of force behind the market, even though market moves up quickly, but you see that there's some of these technical indicators, and you'll see that some of the foreign markets, the DAX, the Nikkei, will actually lag behind the Nikkei. And that's also an indication. You already now see also the transportation index, the Dow Jones Transportation Index, has not confirmed the new highs that we see in the Dow Jones Industrial Average, which is also an indicator. So the indications are there. And that's why it'll be so difficult for a lot of people to avoid not being pulled into this, because as the market soar 20% higher, as I think we can do from here, then I think, a lot of people unfortunately get pulled into it at the wrong time.
You speak about the Buffett indicator. A lot of people say that, they just don't support that metric. They don't believe in it. I've heard you say that you believe in it. You spoke about it today. Can you explain, a little bit more about the Buffett indicator and why you think that that's a good gauge still?
Well, it's obviously a simple indicator, you could say, but you say if you have the size of the stock market and you put that into relation to, or you put it into a perspective of something, that way of doing that is to say how big is the economy and how big would you then say that the valuation of the market should be. And if things are just grown out of proportion, or then you would see that this indicator is higher or much bigger than the economy. That's what we see now. It's like twice the size, as I said. And I think that's an indication. Is it precise that it's then almost double the size of the market bubble in 2007? I don't think we can put it like that. But I just say that this is a very good indication of something that is not that you could say the valuations are frothy. And also if you look at the speculation that we have in the crypto market as well, you have Dogecoin, you have all these meme coins, especially. Do not even have a business, set up a case behind it. It's just more about, will somebody be, interested in buying this, a couple of days from now or in a week from now? That is the speculation that you have, and all the talk about that. So that's also, speculation that we see. So these two things, that you have this indicator and the Buffett indicator there, which I think makes sense. I mean, and again, this is what we also heard into 2000. I remember I was told that it's not about how much money you make, it's about how much money you use actually, and you spend, and marketing. And that was what we were told back then. And this we hear every time into the bubbles, and we just have to say, well, maybe the good old economic ways of looking at things actually work. So I would say that take a look at that to kind of gauge the size of the bubble, and also look at other markets and say, how much do we actually speculate in, where things are not yielding anything, but we think that it will rise in value for whatever reason.
It would make sense to me, and I know, this would not happen, but it seems to me when you're buying the overvaluation of a company, you're hoping for future income. It's sort of like investment real estate. You're buying something, an asset, though the stock market to me is not the same. It's way riskier because you don't really own the stock. Most people don't. And I don't want to get into the semantics of that, but you're buying ownership in something, and that you can't tangibly touch. I mean, you can't. And by the way, the companies are going to protect themselves before they protect their shareholders, and at least the insiders. But it almost seems like there should be some kind of a stop where you would say, okay, once your company is so overvalued, we can't allow it to continue to be sold at that price, but that won't happen. But this is an election year. And the best thing that I'm sure many people in government, they obviously, their jobs depend on at least the somewhat current administration staying intact. And at this point, that would be Kamala Harris. Because Donald Trump, I mean, there may be a lot of jobs cut, people that are employed that may not have their job. I've heard Powell talk, our Fed chairman speak about how they're not affected by political pressures. Some people believe that, some people don't. So far, he's been pretty true to that. You would think, geez, he's letting the economy slow down. He hasn't reduced the rates yet and hasn't cut like the markets had planned. What do you expect? I mean, you had said something about, this recession showing up at the end of the year, certainly the beginning of the year. Do you think they're going to pull it? What are they going to pull? I mean, I've heard you say that you think the Fed's going to cut 0.5 point in September. I mean, obviously that still isn't very much, but you had said even maybe more aggressive cuts before the end of the year. Is that going to be in time for the election? Probably not. So,
I don't know. I don't know what's in the head of the Fed, but I think in terms of it makes sense now that they do a cut. And if you look at the market yields, and they normally should kind of follow the 2-year yield in the market. And if you look at that, that's way lower than what we have right now, the 5.25 area for the Fed fund rate. So I think that it will make sense that they do it rather quick now. And I think they will be forced. So obviously, if you start to see some deterioration in the labor market, and I think it's going to spike. What I talked about, if you start to see the initial claims coming up, if you start to see bankruptcies, if you start to see that the credit card delinquencies, I can only think that they also look to have a look at that. Well, then they will need to do something, obviously. And the only thing they can do is to cut rates for now. So they will do that. And I think, yes, I think they will do that more. We also, in 2007, again, we also had a kind of, we thought the Fed was a little late there back then as well. And they did a 50 basis points also in 2007, in September there, 2007. So I think not because of that, but because of the situation we have in the economy, I think a 50 basis point could be in the cards. I'm not saying it will, but it could be. They're definitely going to cut, but whether it's going to be 25 or 50, but I think they will have to, and they'll be forced to do more into the end of the year. I do not know about the political part of it, because I honestly, I don't think I'm not trying to tell myself that I know anything about the political system in the US, but obviously there could be some perspectives there as well.
Yeah. Well, when you speak about watching the bankruptcies and jobless claims, at least initial claims coming on, I mean, they're lagging. They're lagging indicators. I mean, we're looking at data that is so far behind, and then the Department of Labor statistics come out and they adjust that data. And there are so many things that, manipulate those numbers. So do you have any magical place that you go for this information? Because I mean, we don't see it. I don't think we're getting the true picture.
No, I don't. I mean, I maybe naively, I kind of look to what we get, and then you say, well, this is what we have, and then I try to make some reason of that. And yeah, you could say that there were especially some time where we saw the initial claims just stuck to the same kind of level, and it was like that was a little weird, honestly. But I think that in the greater scheme of things, that I think that you can believe in some of these in the numbers here. So I would hope that, and that's my hope at least. Let's put it like that. Yeah. And again, I don't have any special place to go. So looking at those, I can see that we are still at low levels for that. But if we see some of the other indicators of a slowing economy that comes from the open market position, so open jobs positions, you'll see that they are coming down very, very strongly, and that's because of what as a company, what you would normally do is that first you'll start to slash the open positions. You say we don't need that extra whatever person that is, and then later on you'll try not to cut the jobs first of all. Then you'll actually let them work less, so you see the the number of hours worked in manufacturing, that's another indicator also. And you start to see that also is also declining now. And that is a normal process for any business owner to say, we go through these phases before we have to cut the jobs. So that's why I think, and the initial claims comes out on a weekly basis. I hope they are correct, but yeah, they're definitely, when you look at the NFP numbers, they come with large revisions, and you don't know if so. There was a 272 2 months ago, I think, 1,000 jobs created in, I think it was May, and then I looking at it, you could just say that doesn't sound right, and then it's I think it's reduced to 218 of the last number, and I think it probably is going to go even further down in the next revision. So these numbers, you definitely see revisions in.
Yeah. Well, I know at the end of last year was published, I think it was 479,000 jobs were misstated that didn't exist. But let's kind of, as we wind down here, you've mentioned several times throughout the show crypto. The Bitcoin conference was just in Nashville, Tennessee. Did you go?
No, I did not. But my business partner from the Zeberg report did go. Yeah.
So I was planning to go, but had some family personal things come up that I couldn't go. I had some, I'll use the millennial term, FOMO, man. I had some big time FOMO as I was watching the keynotes on YouTube and, seeing over 20,000 people went. You said that you're very bullish on crypto right now, but you think that there could be some catastrophe on the horizon. And I just want to kind of get inside your head there and get your thoughts, because as we hear, RFK spoke at the conference, and, though I don't think people, who knows whether he's going to have a ability to be the president or not. He certainly didn't have enough votes, apparently, to debate. But he said that one of the first things that he's going to do, these actionable steps, was, have the U.S. invest in Bitcoin. And, we see a lot of governments talking about this thing. You think this is Ponzi scheme, just an opportunity to make money right now? I mean, what do you see as the sort of like the long term on just call cryptocurrency?
I think, like into any other bubble, that you will see a lot of speculation, and that you've seen every time also a new technology arrives. You'll see that there is a lot of speculation. And going back to the 80s, 50s, it was, the rail way, and there was the whole, the steam engine coming out, and then you had a lot of speculation around that, and then you had and you had also when the car came out, or the automobile, and so every time we see that, we see some speculation coming up, and that's why. Of course, there will be some of these companies that will be the next Amazon or the next Apple or something like that. I believe in that. I believe that there will be some of these. But if you look at the amount of cryptos that we have now, I sincerely do not believe that a lot of these will survive. I think that if you see a liquidity crisis that I think we can get into next year, then a lot of these will be struggling a lot. And we still need to see that people, we're talking about people here needing to pay their bills or needing to be invested in something like this. If you look at the whole DeFi, setup, and understanding that Bitcoin could take over as the reserve currency or as reserve, something, I never really understood that, because if I'm quite certain if you ask China today and they said you want the reserve currency, you can, if you could give it them to them right now, they would say, yeah, let's give it, let's have it. Because that's actually what's creating that the ability for the U.S. also to have what I think is an artificially high level of spending. And if you did not have that, then you will have a lot of push on the demand, or the dollar would probably see a lot higher, not much more inflation there. So I think that whole situation around Bitcoin is that people think that can move into that place. I don't think that's going to happen, honestly. And I think it's going to have a place, and I think it could have a place like what people think about with gold and silver and the likes. But this about taking over the reserve currency status is simply that's their geopolitical issues there at stake, which I do not think they will take that any administration will take lightly. So I think when we hear from some of these political candidates are, to a somewhat degree, wishful thinking, because they may want to do that, and maybe it's an expression of the sound money that they want to see. But to actually take that out of the hands of the U.S., which is probably one of the greatest assets that the U.S. has at this point, that the reserve currency, is probably not the best thing for the U.S. or for the rest of the Western world. I think that is what has been keeping the Pax Americana alive for so many years. It's what has been building a lot of wealth in the U.S. and also in the Western world. So I think, and I hope honestly, that we will see a reformation of the monetary system. But I don't think it's going to happen through Bitcoin. And I think that the Fed, and the central banks of the world are going to take this in. I know that the ECB is already working on a central bank digital currency. And I think that when that monetary reset that I think we're going to see at some point is going to come, it's not going to bode well for a lot of these, more DeFi-oriented coins. Whereas the ones that have, sound business, setups behind them, may thrive, and they could become the next Amazon. But
you're
it's
talking
not
about
going
backed.
to be all.
You're talking about backed by something like gold, like
Yeah,
Bitcoin backed by gold.
Bitcoin got backed by gold or something, or the monetary reset that I'm talking about is something backed by gold again. I think that is what we're going to see. I think there will be a basket of currencies maybe, but I may not have the fantasy to understand really what could happen. But this is what I think, and then there will be probably also a digital element to it, or a crypto element to it. So I think we could see that down the road. But will it be taken out of the hands of the U.S. Administration and then placed into a more let's see where it goes kind of world, and everybody can actually have a? I don't think that will happen, and I think the U.S. administration will actually defend that, and I hope they will, because I think it's actually good for the Western world.
So we've given some good advice here, a lot to think about. We said early on, consumers, especially our young consumers, our millennial, our Zs, our alphas coming up, that they should really think about whether they should do that wasteful spending, that they should be more discretionary. And we also said that maybe people should consider how their service, what they offer, could be used abroad or to a bigger audience, to have some kind of maybe a side gig or something to protect themselves from a job loss. So now let's talk about sort of, what would be your advice to people that are trying to have something, have some investments, protect themselves financially from what could happen? Do they buy gold? I mean, what do you tell people that want to have what the baby boomers had for decades?
Unfortunately, I don't think there's an easy solution these days. I mean, if it would be so easy if we just say buy gold. And I think, buy gold could actually, if you look at it in a 5-10 years perspective, I think that could be fantastic. So, but again, would you then see no down, do you not see that it would decline some? I think you'll see into a deflationary bust that the gold will actually crash or have a big decline. We saw that in 2008 as well. We saw gold 34% down from March of 2008 to September of 2008. We saw silver down 60% in that same time period there. So I think there are good times and bad times to buy it. But if you in the greater scheme of things, just say, okay, I need to stick, to what I have. Well, then gold and silver will, be what you need to look to. Because especially if I'm right on this stagflationary part that we could see in the second part of this downturn here, then gold and silver will become at quite different prices. I could see silver at 150. I could see gold at 15,000. I could see many different scenarios. Therefore, much higher prices. But I think there will be some tough times for it first. That will be probably the easiest way to do things right now to take care of your financial wealth. But you'll also have to understand that there will be some ups and downs in that as well also. But 5 years out, I probably think that a lot of people will be happy if they done something like that.
Henrik, great advice. Pleasure speaking with you today, and hopefully we'll get you back on soon in the next couple of months, and as this thing plays out, see where we are. But thank you so much for your time.
Thank you very much for having me on. It's been a pleasure.
Okay, thanks for making it to the end. I hope you enjoyed this interview. And if you did, you can let Henrik and myself know by smashing that thumbs up. That actually helps the algorithm push this video out to more people so that they can benefit to what Henrik is saying that he believes will happen to the U.S. economy in the next year to come. If you haven't subscribed to our YouTube channel, please consider doing so now. Hit that alert bell. You'll know every time we upload content just like this. And folks, we love your comments and questions. In fact, so does our audience, so post them below. And one of the biggest compliments that you can do for me here at Sachs Realty is to share this video and our channel with your family and friends that we can continue to build this online community together. See you next time.
Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.